everyone. We wanted to let you know as the first quarter earnings come to a close, we also finished rebalancing a few days ago. Now that the rebalance is finished, we wanted to provide some insight into the investment committee's thinking and what strategy we're employing over the next several months. After a strong first quarter for stocks, some April showers rained down as the S&P 500 fell about 4%. Hopefully those showers will bring some flowers in the next couple months. So far, May has been blooming nicely. So what caused stocks to dip? Beyond some digestion of strong capital gains, March stubborn inflation and higher interest rates were the main culprits. As the downtrend in inflation has stalled recently, expectations for the start of the Federal Reserve's rate cutting campaign have been pushed out. The Fed Chairman Powell reaffirmed a couple weeks ago that they're still looking at cutting rates this year. Of course, this was wrapped in language like data dependent and other phrases the Fed commonly uses. The first quarter corporate earnings season is nearing its end, with most of the S&P 500 companies reported thus far. Of those reported, 61% of them beat revenue estimates and 79% of them have beat earnings estimates or profits. This second number is well above long-term averages. The key long-term driver of markets is earnings or profits, and those look robust. Another positive signal to note is the amount of share buybacks. This quarter marks the most share buybacks announced since 2018, and currently with $383 billion announced so far. Buybacks typically rise when earnings rise. This is because as earnings rise, which is currently happening at their fastest pace in nearly 2 years, cash flow at companies increases. Companies can then use the cash flow to increase dividends, to increase capital expenditures, and to invest back in the company, and lastly, to repurchase stock. In other words, another way to return capital to shareholders. When the general consensus is for a severe slowdown or recession, companies aren't going to do buybacks. They're going to hold on to that cash, but that consensus has shifted. Economists are feeling more optimistic about economic growth for the U.S. this year. Corporations are confirming that confidence with share buybacks. With the economy growing steadily and corporate profits rising, the near-term outlook for stocks still looks supportive. Throughout the first half of the year, we have continued to deploy dry powder into higher growth opportunities. The growth engine of the portfolio focuses on stocks of companies with healthy balance sheets and consistent growing profits. The broad definition of most of the stocks we own are in the growth category. As always, there will be rainy days. Sticky inflation remains a thorn in the market side, and geopolitics are a potential stumbling block. But for the markets, let's hope the fresh flowers of May continue into June and beyond. If you have any questions, please reach out to us anytime. As always, thank you for watching.